Hello there. Hello there. Thank you for joining me this evening. We are awaiting quite a few people, so we're going to give it just a few more minutes here. I only see a handful of people on so far, but let's give it just a minute here. I did send out a direct link to this. If you got that email, then there's a direct link to StreamYard. Some people are going through Eventbrite, and that always takes a few extra minutes. So I'm just going to give it a one little minute here. I hope everyone is having a wonderful evening. And like I said, I really do appreciate you giving up your precious time to spend it with me. We will try to get through this presentation rather quickly, so there's lots of time for questions at the end here. We will take the questions in the chat, so have something to jot down those questions as we go along, so we don't have to interrupt the flow of things, but I don't want you to forget them either. I will also have the slides available to you, so you do not have to write down everything you see on the slides, just questions pertaining to them, and you can get the slides after the fact. So, all right, I want to respect your time, so we're going to go ahead and get into it here a little bit. Let me make that screen a little bit bigger so you can see it. There we go. All right. Hopping right into it, of course, every good presentation has to start with a disclaimer, right? So I'm not a CPA, financial advisor, or an attorney. This is just information based on what I have learned as a real estate investor in these types of investments. And you should always, talk to those professionals if you want further advice on those types of things. If you want copies of the slides, this is the phone number. You can just text the word slides to that and you will get a copy of the slides. That way you don't have to furiously be writing things down. Again, you want to just concentrate on writing down your questions so we can hit those up at the end. Again, we'll use the chat feature for that, but no need to take a bunch of notes. Just text this and you will get the slides. All right. And I will show that again towards the end if you haven't had a chance to do that right now. Okay, so real quick, who the heck am I? Why would you want to listen to me? So first of all, I am what's called a capital allocator. That means I work for investors, not for deal sponsors. So primarily I got in this business because, well, first of all, because I love real estate. I've been doing that for over 25 years, but I got into the funds and syndications and this larger passive investment stuff because I'm a business owner and I have a lot of cash flow from those businesses. And so I want to invest that. And so every quarter I was investing that. And I found that I could make that money go further if I brought other people along with me into those investments so we can get to the higher level tiers within those investments and get better returns for everybody involved. So I just started scoping out deals for myself to invest in, and then I invite others to invest alongside me. So that's why it's a capital allocator. I'm not the deal sponsor directly in that respect. So I'm looking for stuff for me to invest in. Everything I invest in, everything I offer to anybody else, I'm also invested in. So I do have a personal real estate portfolio worth millions of dollars. I do have single family homes as well as apartment complexes that I have no investors in whatsoever. It's just me and my husband, really. And then I also actively and passively invest in syndications. And if you are new to passive investing, the word syndication might be new to you as well. But all that means is that you partner up with other people to buy something at a higher price point than what you would likely be able to afford on your own. So we might be buying $34 million apartment complexes or something like that. And you're probably not going to do that entirely on your own, right? So it helps to just partner with people. And then everybody gets a shared ownership within that. So that's what a syndication is in a nutshell. And so I do that both actively and passively. And we'll talk about the difference between being active and being passive in that. So we'll get to that further on. I already mentioned that I'm a business owner, so I own 2 Massage Envy clinics. My husband and I do that. One's in Orlando, one's in West Melbourne, and that's where we pull the cash flow of to invest in real estate. And it also helps us out with our tax situation, right? As business owners out there know, the tax burden can be rather large, but real estate helps offset that. So I do invest in every property that I invite others to invest in. I believe I mentioned that. I offer direct investments as well as investments through funds. We'll talk a little bit about that. If you have questions about pros and cons of funds versus direct investments, we can dive into that in the Q&A section if you wish. But basically, in both cases, you end up as a owner of the property. If indeed it is a property, you can actually syndicate anything. It doesn't have to be just real estate. There are people syndicating businesses and all sorts of other things. But all it means, again, is pooling money to get into something together. I currently hold investments in 6 different states plus Puerto Rico. And that is the beauty of being a passive investor, is you can diversify very easily because the property does not have to be where you are. So I'm in Florida, but I have properties in the Carolinas, in Texas, Ohio, all over the place. And because I don't have to do the day-to-day on those kinds of properties. So that's what that is. And I'm also a busy mom. I have got 2 boys, and my oldest son has autism. And so he's one of my big reasons why I do this. He's what I call my big why. We don't know what his future holds and if he'll be able to financially support himself. So I want to make sure I build that legacy wealth to support him long after I'm gone, just in case. I'm hoping he's going to do great. But I also don't want it to be a burden on my other son to have to take care of him, right? So Blue Vikings Capital, here's a little bit about what we stand for. So first of all, the word, the company name, Blue Vikings, comes from the fact that I was actually born and raised in Sweden, and Sweden's the land of the Vikings. So that's where that comes from. I didn't just pick it because it's now, a trending thing for everybody to be saying they're Vikings or all these Viking shows on TV. So that's where the name comes from. But I really do believe that real estate is the most powerful tool on the planet. I don't know anything else where the bank will come in and provide most of the money to go buy that thing you want, right? I mean, try to go to the bank and say, would you pay for 80% of my stocks? Like, that's not going to happen, right? So you can leverage it, that it accumulates in value over time. It just appreciates and has tons of tax benefits. So I really believe that real estate is super good, but it has to be safe too, right? There are all sorts of different ways to invest in real estate, and there are safer avenues and there's less safe avenues. And generally speaking, we want to aim towards those safer ones. There's that risk reward, but it's a teeter, and you don't always have to invest in the riskiest things in order to make good returns. Some people think that's the only way to do it, and you absolutely don't have to do that. So we want to pick things that are not that risky and yet have good returns. And they are out there. There's plenty of them. Not to say that there isn't risk. There's risk in every investment. Everything can go sideways, just like when you buy a stock. If that company tanks, that stock is worthless, right? So real estate, it's hard to lose full value because it's a hard asset, but things can be mismanaged. So we do still want to vet these deals very well. Communication, I find that is very important, whether things are going good, bad, whether things are whatever's happening, the owners always have the right to know. And unfortunately, some operators forget that and they do not communicate very well. Others are fantastic about it. So when I'm vetting operators to invest in, that's one of the first things I look for is what is their level of communication, and can I personally sit in on their asset management meetings so that I can report that to the people investing with me. And so that's part of my negotiation with them, is let's make sure we have those lines of communications open so you can get regular updates on how your property is doing. So that is very important to me. All right, here's a few examples of some of the properties we've invested in lately. And you can see they're kind of all over the place. We've got properties in Florida here, Texas, Ohio. The sizes vary a little bit, but I do try to stay on the larger side. So, around 100 units or so. I don't like to go way below that. And then we've got one here that's almost 300 units, right? So you get that economy of scale when you go larger like that. So that is why that is super important. For me, I think that's really important. And I think you'll agree, if you're going to go buy one refrigerator to fix up a single family house, that's going to be at retail price. But if you're buying 100 of them because you're renovating 100 units, then you're going to get that at wholesale price. And it's the same with everything you do on these properties. It's just more affordable, more economical at those larger scales. So I'm looking at things to invest. I have like what I call my buy box of what I'm looking for. So I'm looking at great markets where people are moving to that area. There's some draw force that's there. There's good employment there. There's more than one employer. So if that one employer tanks, the whole area doesn't shut down, right? We saw that with the car industry in some areas. So I look for things like that. And then if you're new to passive investing, there may be some terminology that you'll see in some of these market packages that you may not be super familiar with. So I'm going to cover the ones that I look at, the top 3, so to speak. There are lots of them, but the top 3 metrics I look for is you'll see what's called the EM, and that stands for equity multiple. And what that means is how much will it affect the money you put in, right? So if the equity multiple is at 2, what that means is for every $1 you put in, you expect to get out 2 by the time this deal is done. So that's an equity multiple of 2. And that's what my buy box is, right? I want to at least be able to double the money in the time frame that the property is in here. And I'm looking at timeframes between 3 and 7 years for the most part, if we're talking about apartment complexes. Most average around 5-year hold time, right? So in that time frame, I want to be able to double the money. Most of them double your money in 4 to 6 years. That's kind of the sweet spot in there. So that's what I'm looking for. I look for an average annualized return. You'll see AAR, average annualized return. I like for that to be north of 20%. So what that means is when you look at all your returns, so the cash flow that you get annually every year, and it usually goes up with each year that you hold the property, and the proceeds that you get from the sale of the property at the end. I want to see that all of that is going to yield 20% when you average it over time. And now that does not mean that you get 20% of your money every year. At first, when you first purchase an apartment complex or anything else that's syndicated, there's going to be lots of cost to buying it, right? You got your closing costs. You may be doing renovations, so you're pushing money into the property. So even the money you get from the rents and such, a lot of times that might be reinvested in the property for a while. So you may not get cash flow the first year, sometimes not even the second year. Maybe it's just a few quarters. It depends on the property you're investing in. Maybe you're investing in a stable asset that cash flows from day one and has distributions right away. Don't know, but it tends to grow with time, and there'll be a business plan that lays all this out for you before you invest, so you know what it looks like, right? But generally, the longer you hold the property, the more that cash flow gets every year. And then at the end, they'll have done all this, that what we call value add, to increase the value of the property. Then they're going to resell it at a much higher price. And that's when you get the vast majority of your money. And then you average that all out over the years, and that gives your average annualized return. So that's what I'm looking to be north of 20% if we can, right around there. Then I also looked at what's called the IRR. That's the internal rate of return. It's very similar to the average annualized return, but it also takes into account the time value of money. So the idea here is if I give you $1 today and you give me back $2 an hour later, I'm really excited. I doubled my money in an hour. That's wonderful, right? But if I give you $1 today and you give me back $2 5 years from now, I'm not as excited, because 5 years from now, that dollar is probably not worth as much, right? So the IRR is a calculation that takes into account the time value of money. So that's why that's really important, right? Because if a deal pays nothing for the entire hold period and then you get money at the end, that's not going to be as valuable as if it gave it to you the first day. So this is in particular important, like if you're doing a new construction project. New construction, there's no cash flow until somebody's living or leasing whatever you're building. And a lot of times when they're building something from the ground up, they're a builder. They generally don't even have a plan to hold it and lease it out. That can happen, but a lot of builders, they just build and then sell. So that might take 3 years or something like that. So for 3 years, you're not making any money on the money you invested, and then you get a really big chunk at the end, right? So when you're comparing that with something that gives you cash flow and then a chunk at the end, you got to look at more than just what the chunks are. You got to think about the time value of money. How long did it take you to get that money back? So that's where the IRR comes in. And so I'm looking for that to be north of 15, 16%, like to get it closer to 20, right? But it's generally going to be less than that AAR because it's taken into account that time value of money. So those are some of the terms you'll need to become familiar with when you're investing in things like this, just so you can compare things. Now, the most important thing, I think, is not necessarily all of their projections in their business plan with all these numbers, right? You may have 2 deals next to each other that have similar numbers, and you're like, well, then why am I not always going to take the biggest numbers? Because it all comes down to the operator, the person actually executing this business plan. It's great to have a plan, but who's the most likely to execute it? It might be that one is more conservative. They think your returns, they might say your returns are going to be a little lower than this other property, but maybe they are just conservative and they execute really well and they'll blow past that. They'll a lot of these sponsors are really good, high quality sponsors who have a good track record of doing this. They like to underpromise and overachieve because then you'll want to invest with them again, right? Versus a new kid on the block might say, well, we're going to shoot for the moon and we're going to do all this stuff, but maybe they don't execute very well. So do look beyond the numbers. You want to look at who's the team behind these properties, right? So those are some things that I look for when I'm choosing what to invest in myself, and then what I'm going to invite others to invest in alongside me. So just a couple of examples there. And I do have examples on my website if you ever care to go to bluevikingscapital.com, where you can actually see some of the webinars on some of these properties. And these are deals that have already closed, so there's no pressure to buy. So it's just a great education opportunity there. All right. So what exactly is passive investing? We've been dancing around it, but let's dive into what exactly it is. So in order to understand passive, we need to understand what active investing is. So a lot of people think the only way to own real estate, or the only way to invest in real estate, is to go buy it yourself and do everything yourself. That is being an active investor. So here's where you acquire something on your own. You manage any renovations that have to take place. You manage your leasing, your managers, you're managing your residents and your maintenance, and it is limited by your time, your knowledge, and your resources. Yes, you might hire a property manager, but you would still have to manage the property manager. You may have to hire a general contractor, but you have to manage the general contractor, all those kinds of things. So this is most common in the single family home space. We see people doing that because most people, tackling something like an apartment complex, that's quite a thing. So that's where we see active investing the most. It's not the only place, but that's kind of what active investing looks like. And that's what people can relate to, is how you would do that if you went to go buy a rental property, for example. Passive investing is where you turn all the work over to some general partners. They're going to do most of that, and you become a limited partner. We'll talk about that more in just a minute. But basically, the deals are presented to you by people who already have a property under contract. So when they get something under property, they have somewhere between 45 and 60 days, sometimes a little bit more or less, to close on that property. So during that time frame, they've got a lot of stuff going on, a lot of due diligence, but they will also present that to investors to see who else wants to come in and be an owner of this property, right? Then once they close on that property, they're going to handle all the renovations. They're going to do the leasing and the managing and the dealing with the residents. And so it's an ability for you to get into larger deals without having to know how to do all that stuff on such a large scale. So it lets you scale your real estate portfolio much, much faster. And this is more common with commercial real estate. And when I say commercial real estate, that doesn't mean it can't be residential. Anything that has 5 units or more in the residential world is considered commercial. But of course, retail shopping malls and hospitals and hotels, all those things are commercial as well. So anything in the commercial frame is kind of what we're talking about here. All right. Again, if you have questions, I know I'm going fast, just jot them down. We will hit all of that towards the end here. So, and then you just have to figure out what's right for you. And a lot of that will come down to how much time you have on your hands and how active you want to be and how much control you feel you need. Because obviously, if you're turning it over to another team, you can't make those decisions. So if you really feel like you need that control, this might not be a good fit for you. But if you are someone who already has a W-2 job, you got 40 hours a week already on your plate, or you're retired and you just don't want to deal with that, and you just want to add to your portfolio and have passive income where you don't have to work for it and just put your money to work, this might be a really good fit for you. But yes, if you're doing active, you do have to have liquidity to buy your own asset. You're going to need some liquidity to get into a passive investing deal too, but maybe not as much. You have to have a net worth to qualify for the loans on that property. You don't have to worry about that on the passive side. You'll be taking all those phone calls from your tenants or your property managers, and you have to have time to deal with finding the investment, vetting the investments, negotiating with the sellers. You also need all the education to know how to do this, going through the closing process on your own, managing the investment while you're still working potentially. So that's kind of what that active side looks like, right? for being a passive investor, you don't get away with doing nothing. You do have some things to do. First of all, you have to decide what kind of asset you want to invest in. I talk a lot about apartment complexes because that's one of my favorite things, but it's not the only thing out there, right? So maybe you want to get into retail or self-storage or industrial warehouses or private lending. There's lots of other options to go passive in the real estate world. You need to define your goals. Are you interested in cash flow versus equity, for example? Those are just two of the things. There's lots of different goals you need to be thinking about, but those are the most common. And everybody says, I want both. Okay, well, there are deals that give you both, but you're generally going to get more of one thing or the other. There are a few deals where you just get, huge volumes of both. And some people just like to diversify and have some things that have lots of cash flow and some things that have lots of equity. And equity just means that you're going to get most of the money on the backside when it sells, right? That resale value. And then you need to have liquidity to invest. So most of the deals have a minimum investment of somewhere between $50,000 and $100,000. Not to say there aren't exceptions to that. There are things you can get into at like 25,000. And also when you see an investment and it says the minimum is whatever it might be, don't assume that that's not negotiable. The world of real estate is full of negotiations. So a lot of times we have people that are investing in their retirement accounts and they have some awkward sum left in their account that they need to place to get that money working for them. And maybe they got $38,000, right? So a lot of these deals, the minimum might be 100,000 or 50,000, but above that, you can invest in like $1,000 increments. So maybe somebody invested $170,000 and there was $200,000 left to fill of that investment. So the sponsor of that deal is left with this like $30,000 gap. So you might be willing to take an investor at 30,000, even if the minimum was 50. They do have that discretion. Bob had a question here. How do most analysts deal if they're not looking at it? Okay, Bob, I will hit that question for you as soon as we get to the Q&A a part of the thing, but I do see your question here, Bob. So anyway, so don't assume that minimums necessarily mean minimums. If you have a smaller amount and you want to get into a deal, by all means, reach out and ask them if they can do that. Finding an operator, that's something you would have to do. You need to attend conferences or webinars like this to get to know people that you can invest with, because you're not just going to find these investments, by Googling them kind of thing. So you need to be either sophisticated or accredited investors. And this is a little deceiving because even accredited investors need to be somewhat sophisticated. So all sophisticated means is that you have to understand what you're investing in. And this should be true with all things that you invest in, whether it's real estate or stocks or crypto or gold bars, doesn't matter. You need to understand it, right? So it just means getting some of the education. So attending a webinar like this is a really good start. There's tons of information on YouTube. There's podcasts, there's books, there's unlimited resource. We are living in the informational era. So go out there and get that information. And I'm happy to help you with that. I've got a lot on my website that you can tap into. And I'm happy just to jump on a call with you and answer questions as well. So by all means, understand what you're doing before you invest. As far as an accredited investor goes, there are some deals that are only available to accredited investors. And that doesn't necessarily mean that it's better deal or worse deal than one that's available to anybody. It just means that the sponsor has chosen to go accredited investor only because it allows them to advertise. If they're going to go to anybody who wants to go into it, there are certain limitations. They can only take so many non-accredited investors, and they have to have a personal relationship with them. So they may do that on some deals and not on others. So it doesn't mean it's better or worse, but there are some deals out there, quite a few, that are accredited investors only. There's lots of protection for the operators when they do it that way. So sometimes that's why they choose to go that route. So what does that mean? To be an accredited investor simply means that you have met a certain net worth or income level. So when it comes to income, it's $200,000 a year for an individual filing their taxes individually, or $300,000 for anyone filing taxes jointly with another person, and that you anticipate that income level will continue for the next 2 years at least. Or, so it's not and, but or you can meet the accreditation limit by having a net worth of $1 million or more. But it cannot count your personal residence. So anything else that you own, if you have rental properties, if you have retirement accounts, if you have stocks, if you have valuable cars, anything else, just money in your checking account counts, anything like that. Some people have collectibles, whatever it might be. Even your cryptocurrency counts towards your net worth. So if you add all that together and it hits $1 million, then you're automatically an accredited investor. And you just need to get some sort of letter from your CPA or somebody else familiar with your finances that signs off and says you're an accredited investor. So that's all that means. And then, of course, you need to learn how to analyze the deals. So that goes back to that educational component. That's very important. All right. So you don't get off without doing anything, but you don't have to do anything pertaining to the property as well. So this is kind of how the structure of this looks like. So whenever a property is purchased or a business or whatever they're syndicating, it will form a new LLC. And there will be two classes of members in that. There will be general partners. So these are the ones that are often called operators or sponsors, or sometimes they're called syndicators. It all means the same thing. We refer to them as GPs for general partners. So those are the people who are going to do all the work, and they're going to get paid for that work that they're doing. Okay. Then you have the limited partners or the passive investors, right? And they are going to get paid because they put money into the deal. And that doesn't mean the GPs don't put money into the deal. They most certainly do. Most of them put in quite a bit of money into the deals, but they're getting paid beyond that. They're getting paid for their work. Versus the limited partners, they're just getting paid for the fact that they came up with the money to purchase this asset. So again, the banks usually provide the big check, right? So they might provide anywhere from 65 to 80% of the purchase price of that property. And then the investors are just making up the difference there. So it's the same as the down payment on your house, if you're coming up with a down payment on a house, right? So that's the part that the limited investors or the LPs are putting in. So that's kind of the structure. But everyone's an owner, so you do receive the tax benefits of ownership in real estate. You get to partake in the upside of it at the sale. You get to have either monthly or quarterly cash flows if the property offers that. So that's kind of how that looks. All right. Benefits of being a passive investor. We've kind of talked about some of these, but mainly it's that hands-off approach, no dealing with the tenants in the toilets. And all you really need to do is review those quarterly reports, and that's about it, assuming they're quarterly. Some might be monthly, but you do want to look at those. Real estate doesn't move so fast that you necessarily need to check on it every week or every quarter. This isn't like stocks where they're hopping up and down, right? Real estate's a pretty stable and slow-moving thing, but you want to make sure the trend is up, right? Your occupancy is going up and your rents are going up and all that kind of stuff. That's what you want to look for in those quarterly reports. There's a potential for the steady cash flow. Again, depends on the type of deal you're investing in. New constructions is one of those that does not pay that cash flow, but you want to see how that goes. So that's one of the benefits. And then diversification, we talked about this. You can diversify in different areas. You can diversify with different sponsors. You can diversify with different asset types. And you can also diversify with different asset classes. So even an apartment complex, okay, that's one type, right? But there are different classes. There's what we call type A class, Class A properties. Those are like your newest product with all the fancy amenities. You know, they got the gym and the putt-putt and the pool and all that kind of stuff, right? And then you got things that are slightly older, maybe still have some great amenities, but they're just a little bit older. Those might be your Class Bs. Class C is more your workforce housing. It's not going to have all the fancy amenities. It's just kind of this apartment complex. And then Class D, that's going to be kind of the bottom of the barrel kind of stuff. Older, maybe in a sketchy neighborhood, definitely no amenities, that kind of stuff. There are pros and cons to all of those, and you can diversify within those. So generally, Class Ds are more cash flow, less, you're not going to get as much when you resell it, right? So less equity. When you get to Class As, they may not have as much upside. Sometimes they do, just depends, but may not have as much upside, but it's very stable, very safe. that kind of thing. So it just depends. And the business plan, again, will lay out all the pros and cons of the various investment. But you can diversify. And then tax benefits. So I'm going to spend a little bit of time on this. I am not a CPA. I'm going to stress that. But I have seen these tax benefits firsthand. So they can be very powerful. If you're familiar with depreciation, when it comes to commercial real estate, when you start scaling, there's a lot of that. And so that is a big investment. You get depreciation on the full value of the property. And remember, the bank is coming up with 65 to 80% of the value of the properties, right? So, but you get depreciation on 100% of it. So you're going to get a lot more depreciation than you would think, dollar for what you're investing. So that's one of the really big benefits. And if you're not familiar with depreciation, basically what it is IRS has kind of charts for depreciation for just about anything. So anything in business that's going to be some item that's going to be around for a while, you can depreciate it. So let's say I have a tree trimming business, okay, and I'm buying a chainsaw for that business. IRS might say, and I haven't looked this up, I'm just guessing, but let's say IRS says that chainsaw is worthless after 5 years. After 5 years, it's going to be worn out, and you got to throw it away. So they'll let you take the value of that chainsaw, what you paid for it, and depreciate that over 5 years. So you can write off that much on your taxes each year, because after 5 years, you're going to be chucking that thing out. So that's kind of what depreciation is. So, and in most cases, those items that they're talking about do in fact depreciate and will be worthless after some period of time. Your cars depreciate, right? Their value does not hold. It goes down with time and eventually they might be worthless. But we do know with real estate, it tends to go the other way. Just ask what your parents paid for their house. If their house is still standing, see what it's going for now. They tend to go the other way. They tend to appreciate. So this isn't a true loss of value. It's just a paper loss. So it is really just a write-off that saves you on your taxes. So that's what depreciation is. So in the case of an apartment complex, for example, the IRS says it's worthless in 27 and a half years. Well, pretty darn certain 27 and a half years from now, it's going to be worth a whole lot more money. But meanwhile, you can take the value of that asset minus the value of the land and depreciate that over 27 and a half years and take that write-off every year. So that gets split out amongst the various investors based on how much you invested in the property. But we can make it even greater than that. When you buy these larger properties, you can do something called a cost segregation study. It's usually not worthwhile to do this with a smaller property because there's a cost to doing this because you have to bring in an engineering firm to do this. But it makes sense with the bigger ones because of the depreciation you get. And basically, this engineering firm comes in and looks at everything in that building. I mean, down to the doorknobs. And they say, and they put everything kind of in a bucket for how long will this item last? So they might say, hey, IRS, okay, the building itself might have 27 and a half years of life, if that's what you say, but the roof, it's only got 15 years. So we're going to put that in the 15-year bucket, okay? The appliances, 10 years. In 10 years, that's the most that these appliances are going to last, right? And like I said, all the way down to the doorknobs, every little thing in that building, they're going to put in a different bucket of how fast it's going to depreciate. And then you get to depreciate those things much faster. And that can be a very big part of the property that you get to depreciate much faster. So if you're holding these properties 3 to 7 years, and you can take a bunch of that depreciation up front, that's a big savings up front, right? Now, the depreciation, oh, one more thing, crazy thing. So we had all this economic stimulus acts passed, right? And one of them stated that we're going to give you bonus depreciation. So as if the depreciation wasn't already big enough, and then we had cost segregation, now we're going to have bonus depreciation. And what that did is it looked at all those things that you've put in your cost segregation study to speed up the depreciation on. You're going to be able to take a certain percentage of that all in year one. They actually started at 100% of that. Now it's down to 60%, but there's currently a bill sitting in the Senate, I believe, that if that gets signed, they'll go back up to 100%. So we'll see what happens with that. Now, there's no such thing as a totally free ride. So if you're a CPA out there, you're listening to this, you already know this, but there is something called depreciation recapture at the end. So it's not, just tax write-offs all along. You're obviously using some of that depreciation, but not all of it as this property goes along. So there will be some depreciation recapture on the end, but it means while you own the property, you get the benefit of those write-offs. So you can reinvest that money that otherwise would have gone to the IRS. So you're ahead even if you were to pay back all of the depreciation. Um, but that's not necessarily what you'll have to do. But also, the depreciation recapture comes at the sale of the property when you're getting that big chunk of money back, hopefully, right? So that's when that would kick in. What a lot of people do is they then invest in something else, and they continue to kick the can down the road for the taxes, and ultimately they may never end up paying them, or they just set off a certain percentage. But that's a question for the CPAs. I'm not going to dive any deeper into it. There's lots of strategies around that. But the big question, the big thing just to emphasize here is that there are lots of tax advantages with these big properties. All right. Types of investments. We've talked a little bit about my two favorite ones. So that's why I've got on the slide here is my favorite ones. So multifamily, which is apartment complexes, and private lending are kind of my favorite, but there are others. So we'll touch on those as well. But let's just talk about different risks and different rewards in different assets. So when it comes to apartment complexes, economic downturns can impact your residents. So that's something to look for. What is the economy doing right now? Because it might affect what asset class you want to get into. I mentioned class A, class B, class C, and class D, right? So depending on what the economy is doing, you might want to be in workforce housing, or you might want to be in luxury housing, right? If everything's going great and everybody's starting to make more money, maybe there's going to be more of a push to get into that luxury housing. But if things are going the other way, maybe some of those people who were living in those luxury apartments are going to step down to your class Bs, right? Or maybe you just always want to shoot for the middle. Maybe you want to be class B, class C apartments all the time. So regardless of how it shifts, people can move up or down in these classes, and you continue to cash flow. So that's one thing to look at. They can be very competitive. So if there's an area that's really overbuilding on apartment complexes, they might start to compete with each other on rent to attract the tenants. So you maybe don't want to be there if it's overbuilding too much. What you want to be is in a market where there's lots of people moving to it and they haven't been building fast enough to keep up. That's really where you want to be. But those are things to look out for. There can be property management challenges. I'm going to tell you there's always some sort of property management challenges. It's a matter of how well the particular people deal with those, right? The particular managers. But those are definitely some risks. Sometimes we go in and buy apartment complexes where they have been mismanaged. Maybe it was a mom and pop kind of operation. Folks got older, retired, they were kind of ignoring the property, and we can come in and really do a good job of fixing it up and getting it back on its feet. So those can be some opportunities in there. The rewards, of course, the stable cash flow that you can get, the economies of scale that we talked about, the appreciation, the demand for apartments right now is huge. And long term, it tends to always do well. But particularly now that the cost of single family homes has really gone up, the younger generation, unfortunately, is going to have a very hard time getting into ownership of a single family home. So we think more of them will be in apartments longer. I think that's going to become more of the norm. My kids are at that age where I'm, wishing I could help them buy a house. Well, I could, but I want them to do it on their own. And but that it's really hard for the younger generation right now. But that does increase the demand on this particular asset class, and it's one of the reasons I like investing in it. And of course, we talked about the depreciation and getting you those tax benefits. Another one of my favorites is private lending. So this is more of the cash flow play. We talked about, cash flow versus equity. In private lending, you're lending money to other people, right? So you're making money on the interest payment there. And there's no equity on the end, right? You're not going to hopefully have to take over that property. That would happen in a foreclosure kind of deal. But so you're just doing nothing but lending money. Somebody else is doing all the hard work. This is particularly popular with flipping of houses. So there's lots of debt funds. We have a debt fund with Blue Vikings Capital that lends to people who are rehabbing and reselling properties. And so they hold them for 6 to 9 months. It's a very quick turnaround. You put your money in, you get it back out, and you make good interest on that. So that is a very just high cash flow kind of thing, but there's no equity on the end. You do not get the tax benefits, but you do get that stable cash flow. It pays out every single month, usually between 7 and 10%, depending on how much money you invest in these various funds. And you're not lending directly on one property if you're investing through a fund, because the fund lends on lots of properties. So if there is one foreclosure or two foreclosures within the big fund, it doesn't really affect you personally because your money isn't tied to one property, it's tied to the fund as a whole. So you continue to get your distributions. So again, it's a good place to put like emergency funds that you want to keep liquid because you can pull money in and out of these things, versus when you invest in an apartment complex, it's in there pretty much for the life of that deal. It's not liquid like private lending would be. So those are two of my favorite ones to kind of blend together. There are others. Let's see. What are the other ones? Medical offices are great because you get triple net leases where the tenant, that doctor's office or whatever it is, they're going to handle all costs associated with that building. So if the air conditioning goes out, it's on them. They got to pay the insurance. They got to pay the taxes, like everything. So it's really just hands off. It's a very long-term lease, tends to be very stable, very predictable. So a lot of people like those triple net leases, like medical offices. You know what you're getting into. Self-storage, very popular because there's no landlord issues. There's no humans living there. So you don't have those landlord laws to worry about. It's all on a month-to-month basis, those leases. So you could theoretically, I won't recommend it, but you could theoretically raise the rent every single month. Okay, you're probably going to lose all your tenants, right? Your tenants being the boxes that are living there. Someone's going to move those boxes somewhere else if you were to do that. But you're not locked into a particular rate. You can raise those rates. You can kick people out if they're doing something they're not supposed to. Again, no landlord laws. So lots of flexibility there. A lot of people like the self-storage space. Mobile home parks is also very popular because here you just own the land in most cases, not the homes on them. So you don't have to deal with all the care of the actual the home. You're just maintaining the land and renting out the land for someone to put their home on. Industrial space is another popular one, especially over COVID. We saw this huge increase in people shopping from home, right? So these warehouses built up everywhere. So a lot of people invest in these warehouses, not just for Amazon, but a lot of things are just distributing things to send straight to your door. I see people do syndications in car washes. I have not invested in one myself, but they're popping up all over the place. They're very popular. So that's one, but there's competition heating up there. So anyway, those are some of the favorite asset classes out there that you can invest in passively. All right, so how do you start that? Well, first you have to decide where you're going to pull money from if you're going to go into this. So obviously, if you got cash sitting around, just come talk to me. Just kidding. But you should not have cash just sitting around. Even if it's sitting in a savings or CD, you're just not, that money is just not working very hard for you. So you should find some place better to put that. That's all I'm going to say there if you're sitting on cash. A lot of people have retirement accounts and they don't realize that they can invest in real estate through their retirement accounts a lot of the time if you own that account. So if you're currently employed by somebody and it's their retirement plan while you're employed with them, you probably only get a little selection menu of what you can invest in, something that your employer put together. And you're kind of stuck with that. But if you worked for somebody else in the past and you don't work for them anymore, you now own that plan. And you can choose to self-directed, pull it out of whatever they've got it in and put it into whatever you want. And it's very flexible. You have to get a custodian that does this on your behalf. And you tell your custodian, hey, I want to invest in this apartment complex, or I want to do this private lending, or I want to go buy gold bars or crypto or whatever. Like there are some limitations on what you can do, but it is very flexible. So you can self-direct those accounts. And if you don't have a retirement account, you can establish one. And you can establish as a self-directed right from the beginning. So an IRA or solo 401k, or regular 401k, any of those things can be self-directed. And then it's very flexible what you can do with them. And there's tremendous tax benefits to investing inside a retirement account. Your deferred taxes, or you pay the taxes up front. I love Roths. You pay the taxes up front when you put, let's say, put 50,000 in there, right? And then it grows to 100,000. Maybe then it doubles again to 200, 400. Eventually it's millions of dollars in there. And when I pull that money out, it's tax-free. I only paid taxes on that initial 50,000. Now I'm pulling out millions tax free. So Roth is a very powerful way to go. So you might want to do that. If you have brokerage accounts with stocks, I have nothing against stocks. I have stocks myself. They are great for emergency funds because you can cash them out at any time. They're liquid, right? But stocks can be very volatile. They can be up and down, and Lord forbid they're all down when you really need that money, right? And especially during times of elections, we see that stock market hopping all over the place. So, and there's no tax benefits, and you can't borrow money to go buy stocks. So you can buy a little bit on margins. We're not going to get into all of that, but for the most part, not like you can to go buy real estate where the bank gives you this big chunk, right? So it might be time to diversify some of that. If you've got everything sitting in a brokerage account, maybe you want to look at diversifying that. But always make sure you have some money that is liquid. Should you have emergencies, I like to keep at least 6 months of expenses on hand where I can get it. So I'll put that into brokerage accounts and private lending because that's where I can pull money back out. So keep that in mind for those kind of things. Also, in the getting started with passive investing, you need to, of course, decide if this is even for you. So you want to do that financial assessment, see where you're at. And then you need to find a capital allocator like Blue Vikings Capital that can help you find great deals to invest in. You want to set up a discovery call with them or qualification calls. This is not a sales pitch. No investments are presented during these calls. What this is to make sure that you're a good fit for these things and to help you figure out what might be best for you. Okay. Like I said, there's lots and lots of options out there, and you need to decide, are you looking for equity? Are you looking for cash flow? And there's a lot of other things that you need to decide what's good for you. So this is really just to feel all that out and for you to get a chance to get to know that particular capital allocator. There's lots of them around. I'm not the only one. And so you might want to set up a multitude of these calls and just see who you're comfortable with, right? And then once you've done that, you want to join their investor club. This is how you ultimately get notified of the deals that they have, right? So you may, a lot of these deals feel very quickly, right? So I might have 5,000 investors on my investor list. I may have an investment coming up where I have room for 30 people, right? So I'm going to send that out, and I'm going to send it out to my investor club, right? I'm not going to start by putting it on social media or on the website, on that kind of stuff. I'm going to go to my investor club, particularly if it's not open to anybody to where you can advertise, that no one else is going to see those kinds of things. So I'm going to send that out to my investor club. So you want to make sure you've had that intro call, and so that you can be qualified to do that and join those clubs so you can be the first ones notified of these kind of things. You want to really do that education and research so that you know what you're comfortable with before the investment comes in front of you. And this is super important because, like I said, a lot of these deals, they fill very quickly. And I have a lot of people get mad at me that they finally decided they want to get into this deal, but it's too late. All the spots are full and you end up on a waiting list. And sometimes when you're on a waiting list, you do actually get into the deal, but a lot of times you don't. And then they're like, oh, I spent all this time analyzing this and now you can't get it. So it's good to do that kind of stuff in advance. So research, figure out what you like. Like I said, I have stuff on my website of past deals you can look at. So there's no temptation to jump into it. And when you get an email, say you join an investor club and you get an email that says, hey, here's a property that's available. I would immediately set up a call to talk to the allocator about that particular deal. They'll often have a webinar that you can attend to and ask questions, or there might be a recording about it. Look at it, even if you have no interest in investing. As a matter of fact, I suggest you don't invest in the very first thing, right? Go and just talk to them about it. By setting up that call, you're going to force yourself to research the property before you get on the call so you know what you're talking about and have your questions lined out. And having done that a time or two, you're going to feel so much more comfortable. So then when you see something that really fits your buy box, you're going to develop your own little buy box of what you want to get into. You'll be ready to jump. And then you won't miss out on those opportunities because you've already screened a few deals and you now know what really works for you. So I really suggest doing that. Yeah. Okay. So that's kind of how you get started in that. If you want to learn more, I do have a book. It's free. You can download it. And it's just an ebook. You can read it on your iPad or on your device or whatever, or you can print yourself a copy if you like lots of paper. But This kind of helps you choose that first passive investment, kind of has the checklists for what to look for. And if you have invested in the past, this is also a good checklist to make sure you haven't been missing something. All right. What should you be looking for in that market? What kind of things should you be looking for in the business plan? What do all those terms mean? AAR, IRR, equity multiple, all those things that we discussed early on. So feel free to grab a copy of that book, and that might be a helpful resource to you. All right, so we have gone through quite a lot. So let's review what we have gone through here and see where we're going here. So we've talked about active versus passive investing. We've talked about the structure of passive investments and the benefits of passive investments. We've talked about the various asset types and the classes and how to get started. So that's hopefully you've absorbed all of that. Again, you can get the slides if you want the slides to review this on your own time. I've got something saying that I can't be heard. Hopefully that's not everybody. Hopefully that's just one person who can't hear me. All right. Drop a comment if you're having trouble hearing me. I'm assuming everybody would have dropped off if that's the case. I hope that's not the case. But anyway, if you want a copy of the slides, just give me a text, say slides, and we'll shoot those over to you. I can also get you the full recording of this webinar. I'll go ahead and send that out. I'll just go ahead and send that out. So here's kind of what the investment process looks like if you decided to go down this road. So first, of course, that preliminary phone call that we talked about, there's no charge for these, by the way. So I work for free. So use me. I am a free resource. I don't get paid by the investors directly like that. I'm getting money on the money I'm investing. And yeah, so no charge for that. A lot of people hesitate to set up calls. They think it's going to either be a sales pitch or that they have to pay for it. Neither of those is the case. All right. Then you have to get qualified. Like we said, some might have that net worth requirement if it's for accredited investors only. So then I'll have to get that letter from your CPA or an attorney that's familiar with your financial situation or a financial advisor, something like that. Then once you're accepted, you can join those private groups, the investor groups or whatever, so you can find out about those investment opportunities. When one comes out, you want to take the time to really review it. Go to the webinars, look at the offering memorandum. That's a mouthful. Offering memorandums, or also called pitch decks, that kind of run through what it's all about. And then if you decide to invest, you start off by making a soft commitment. So this is just something that says, hey, I'm interested in investing. This is my name. This is how much I want to invest. And I want to invest either through my retirement account or cash on hand or whatever. And once you submit that, assuming you didn't end up on the waiting list, because the soft commitments will go on the regular investment as well as the wait list. If you're the ones who made it on the top, then you'll get the full investment documents. And these are long and they can be scary. And it's totally okay to ask for another phone call with the capital allocator at that point to say, can you explain what this 100-page document means to me? Yes, it can be 100 pages. I've seen them as much as 300 pages. It's a lot of attorneys just writing the same thing over and over again. Sorry if there are attorneys on the call, but you guys drive me crazy with your repetitiveness. But nonetheless, it's totally okay. You want to be comfortable with those before you sign it. But once you do sign it, then now you're going to be officially in the deal as soon as you wire in your money. So those are two things that are required. And then they're always first come, first served. It's first persons to sign and wire those. But you do hold your spot while you're on that soft commitment form until you pass whatever the deadline for that deal is. So you want to get on the soft commit. You're not actually fully committed until you've had a chance to review those documents. So you can still pull out even after you've signed the documents. If you decide not to wire the funds, you can pull out. But please do the courtesy to the person that's doing the capital allocation of letting them know that you're not going to invest at that point so they can free that up for somebody on the wait list. And then congratulations, you are in the investment. You'll now be able to track your investments and read all the updates, reports, and everything through the investor portal. So you'll be logged into investor portal at that point. So that's kind of what the process looks like. Again, if you're interested in joining my investor club, you can certainly do that. Here's the QR code for that. It will prompt you to set up that meeting with me as well, right? So you can go ahead and join the club, but you'll get an email that says, hey, please schedule this call, or you might get these notifications of these properties, but you may not qualify for them if you haven't had those calls. So it's actually required for any non-accredited investors. It's the law says you must have had meetings and gotten to know this person that you're investing with before you have an investment opportunity shown to you. So it's actually the law. We're not just being pests. So that's what that's all about. So that's kind of it. We're going to move on to the Q&A section here. So if you've been taking notes, get ready to put those in the chat now. But remember, I am a capital allocator. I work for the investors, not for deal sponsors. So I am far less biased than if you're speaking with someone trying to close their own deals, right? They're going to be really pushing their deals very hard. I'm vetting investment opportunities all over the place. I look at hundreds of deals. Like I'm picking the cream of the crops. I'm investing my own money every time. And then I only after my money is in, am I inviting others to invest alongside me. So by pooling our money, I can negotiate far better returns for all of us because we are collectively bringing a larger check to the table. When people invest through my company, they often get higher returns than people who invest directly with the deal sponsors. A lot of times deal sponsors, they have these tiers, right? And the more money you bring, the higher tier you get. So you might get higher preferred returns, a higher equity split, all these kinds of things if you bring a bigger check. Well, we don't all individually have to bring that $1 million check. We can all bring $50, $100, $1,000 checks, right? And collectively hit those $1 million marks so that we can get the higher tiers for those investments. And then again, if I'm bringing in $2 or $3 million to a deal, a lot of times I can negotiate an extra 100,000 on the back end or a higher equity split. Everything's negotiable in the world of real estate. So that's kind of what I do is I'll put that together. And then you also have the benefit of that third party in the middle looking out for your interests. So as I mentioned, my services are always free. So use me, use my knowledge, use my experience, and help you navigate all this. So, all right. So feel free to start popping your questions in the chat there if you have them. And I will stay on for a few minutes to answer anything you have. So I've got one here. Let's see from how do you analyze a deal if they are not used to looking at it? So this is where that education process comes in, right? And there'll be those checklists of what you want to look at. So you want to make sure it's going to be in a growing market, for example. You want to make sure you're with a sponsor that has a good track record of doing this kind of thing. So there'll be all as part of that education process, listen to the podcast. I love listening to podcasts. There's so many great podcasts out there on this topic. I'll be walking the dogs or working out or driving. I'll pop in some earpods and listen to some podcasts. Great way to learn. Lots of YouTube videos out there for learning this kind of stuff. So by all means, take advantage of those. Free resources like my book are out there. And so that's how you learn to analyze a deal. So you don't necessarily need to dig into all the financials, although you can ask for that from the sponsor. You can say, I want to see all of your underwriting. So if you are one of those spreadsheet people that want to see exactly where all the income and expenses are, that's usually available to you if you want to do that. And there are classes to learn how to do that. They're usually boot camps. They're usually like 2 or 3 days where you learn to analyze all those statistics, like what is a reasonable rate increase rates in particular areas. What's the value of adding a washer dryer to an apartment complex? How much more rent might you get for that? So all of that information is out there, but you do have to go look for it. So let's see, we got another question here. To consider investing with you. So the minimum, as I said, for a lot of the syndications are usually 50 to 100,000. But for new investors that just want to test it out, a lot of times if I'm setting up my own fund for it, I have control of how much money goes in there. So the deal itself might have a $50,000 minimum, but I might choose to let somebody in at 25 or 35 because they want to test the waters. So as long as I'm doing the fund to invest in them, I have control over that. And so I'd say 25 is probably the minimum. For the private lending, 25 is always the minimum on those. So we go down to 25 on those. So that's kind of where those are. So, all right. I'm not seeing any other questions at this time. Yeah, and we are right at that 1 hour mark. But if you have additional questions, by all means, reach out to me. My email address is right there on the screen. And you can also just set up those calls and we can tackle anything specific to your needs whenever you want to talk about it. So thank you so much for joining me. I hope it was worth your evening. And if I can answer anything else for you, please just reach out. Have a wonderful evening, everybody. Take care.